For years, $2,000 sounded impossible. Then people said $2,500 would never happen. When gold crossed $3,000, many investors called it the top. But today, the conversation has completely changed. Gold has now reached the $4,500 milestone, and the biggest question on Wall Street is no longer whether gold is in a bull market. The real question is this: is $5,000 the next destination, or has this rally finally gone too far? What's fascinating is that this isn't just retail investors getting excited. Some of the world's largest financial institutions continue to maintain a constructive long-term outlook on gold, even after this historic rally. Banks, including J.P. Morgan, Goldman Sachs, Bank of America, and Morgan Stanley, have all discussed scenarios where gold could continue climbing if the macroeconomic backdrop remains supportive. So today, we're going beyond headlines. We're going to break down the charts like professional analysts, examine what institutional investors are watching, and explain why so many experts believe the next phase of this rally could still have room to run. Let's begin with the charts, because price always tells the truth. When you zoom out to the weekly chart, something becomes immediately obvious. This isn't a random spike fueled by speculation. Gold has been respecting a powerful long-term uptrend for years. Every major correction has eventually attracted buyers. Every pullback has created another higher low. And every new breakout has been followed by another expansion phase. That's exactly what institutions like to see. Professional money doesn't chase every green candle. They look for trends that have remained intact through multiple economic cycles. Right now, that long-term structure still favors the bulls. Even after reaching $4,500, the weekly trend hasn't shown the kind of technical damage that usually signals the end of a major bull market. Instead, buyers continue defending higher levels. That tells us confidence remains strong. Now let's move to the monthly chart, because this is where things become even more interesting. Monthly charts filter out short-term market noise. Instead of reacting to daily headlines, they reveal the bigger picture. Gold recently completed one of the strongest multi-year breakouts we've seen in decades. For years, prices struggled below major resistance. Every attempt higher was eventually rejected. But once that ceiling finally broke, something changed. Resistance turned into support. That's one of the most important concepts in technical analysis. Markets often spend years building energy beneath major resistance. When that resistance finally breaks, entirely new price discovery begins. That's exactly what we've been witnessing. Instead of trading inside an old range, gold is now creating fresh all-time highs. History shows that these types of breakouts rarely end after only a few months. They often continue much longer than most investors expect. That's one reason institutions remain optimistic despite today's elevated prices. Now let's talk about trend lines. Many retail traders underestimate how important long-term trend lines really are. Professional portfolio managers don't. If you connect the major lows from previous years, you'll notice something remarkable. Gold has continued respecting the same rising trend line throughout this bull market. Every major correction eventually found support near that structure before buyers stepped back in. That tells us demand hasn't disappeared. It has simply been waiting for better prices. As long as that rising trend line remains intact, long-term momentum continues to favor higher prices. Could we still experience corrections? Absolutely. No market moves straight up forever. But healthy corrections inside a powerful uptrend are very different from the beginning of a bear market. That's an important distinction many investors miss. Next, let's discuss moving averages, because institutions rely on them more than most people realize. Moving averages help identify the market's underlying trend instead of reacting emotionally to every price swing. Right now, gold continues trading above the major long-term averages that professionals monitor. The 50-period moving average remains above the 100-period average. Both continue holding above the 200-period moving average. That's a classic bullish alignment. Think of these moving averages as layers of support. Whenever prices temporarily decline, institutions often watch these areas to determine whether buyers are returning. As long as gold remains above these major averages, the broader trend remains healthy. If those averages begin turning lower together, then the conversation changes. But today, they continue pointing upward. That tells us momentum still favors the bulls. Now let's move to one of the most misunderstood indicators in technical analysis, the Relative Strength Index, or RSI. Whenever gold reaches new highs, people immediately look at RSI and say, gold is overbought. But here's something many new investors don't realize. Strong bull markets often stay overbought for much longer than anyone expects. An overbought reading doesn't automatically mean prices must crash. Instead, it often tells us that buyers remain in control. The more important question is whether RSI begins making lower highs while prices continue making higher highs. That's known as bearish divergence. Historically, those divergences deserve attention because they can warn that momentum is beginning to weaken. At the moment, however, momentum still appears remarkably resilient. Yes, gold has rallied aggressively, but momentum indicators continue showing strong participation from buyers rather than widespread exhaustion. That's another reason institutions haven't abandoned their bullish outlook. Now, before we move into the macroeconomic story, here's something worth thinking about. Markets don't climb because everyone suddenly becomes optimistic. They climb because demand continues exceeding supply, and right now several forces are working together to keep that demand surprisingly strong. The charts are telling one story, but the economic backdrop may be even more important because technical analysis explains what is happening. Macroeconomics explains why it's happening, and that's exactly what we'll cover next. We'll look at the Federal Reserve, interest rate expectations, Treasury yields, the US dollar, and why these forces could determine whether gold simply consolidates around current levels or begins the next leg toward $5,000. Now let's move away from the charts and talk about the forces that are actually driving this rally. Because no matter how bullish a chart looks, it still needs a fundamental reason to keep moving higher. And right now, several powerful macroeconomic factors are lining up in gold's favor. The first one is the Federal Reserve. For the past few years, gold has reacted to almost every major Fed decision. Whenever investors believe interest rates are close to peaking, or that rate cuts are becoming more likely, gold tends to respond positively. That's because lower interest rates reduce the opportunity cost of holding a non-yielding asset like gold. Recent market expectations have increasingly focused on easier monetary policy as inflation has cooled and parts of the U.S. economy have shown signs of slowing. Those expectations have helped support the latest move higher in gold. But interest rates are only one piece of the puzzle. The second piece is Treasury yields. Treasury bonds are considered one of the safest investments in the world because they generate income. Gold, on the other hand, doesn't pay interest. So when Treasury yields rise sharply, investors sometimes move money away from gold and into bonds. However, when yields begin falling, gold usually becomes more attractive. We've seen exactly that relationship play out recently. After Treasury buyback announcements and softer economic data pushed yields lower, gold quickly found new buying interest and climbed back above the $4,500 level. But there's an even more important indicator that professional investors watch: real yields. If you've never heard of real yields before, don't worry. They're actually very simple. Real yields measure how much investors earn after inflation is taken into account. If inflation is running higher than the return you're receiving, your purchasing power is shrinking. That's where gold becomes attractive. Historically, gold performs best when real yields are falling because investors begin looking for assets that can protect long-term purchasing power instead of simply generating interest income. That's one reason institutional investors continue keeping meaningful exposure to precious metals. Now let's talk about another market that almost every gold trader watches every single day: the US Dollar Index, or DXY. Gold and the dollar often move in opposite directions. When the dollar strengthens significantly, gold usually struggles because it becomes more expensive for international buyers. But when the dollar weakens, global demand for gold tends to improve. Recently, a softer dollar has been one of the major catalysts supporting higher gold prices. Combined with lower Treasury yields, it has created an environment that has been favorable for precious metals. Now let's move to what may be the biggest long-term story of all: central banks. Retail investors buy gold. Institutions buy gold. But when central banks begin accumulating gold, the market pays very close attention. Why? Because central banks don't trade for next week or next month. They think in decades. Countries including China, India, Poland, and Turkey have continued increasing the role of gold in their reserve strategies over recent years. Behind those purchases is a broader desire to diversify reserves and reduce dependence on any single reserve asset. Reuters recently reported that official sector demand has remained a major structural support for gold, with many central banks indicating they expect to increase their holdings further. Another reason this matters is the growing discussion around BRICS economies. Whether every proposal succeeds or not, one trend is becoming increasingly clear. Many emerging economies want greater diversification in international reserves. Gold naturally becomes part of that conversation because, unlike paper currencies, it carries no issuer risk. That steady official demand has created a strong long-term floor underneath the gold market. Now here's where the story becomes even more interesting. Why are so many analysts suddenly discussing $5,000? A few years ago, a $5,000 gold target sounded unrealistic. Today, it has become part of mainstream institutional conversations. That doesn't mean every bank expects gold to reach $5,000 tomorrow. It means more analysts believe the long-term conditions required for such a move are becoming increasingly plausible if supportive macro trends continue. Several major Wall Street institutions, including Goldman Sachs, JP Morgan, and Bank of America, have maintained constructive long-term views on gold, although they differ on timing and the path prices may take. Some analysts argue that persistent fiscal deficits, central bank demand, geopolitical uncertainty, and a weaker dollar could eventually justify much higher prices over time. Others believe investor demand will also need to accelerate before gold can sustain a move toward that level. Now let's talk about the metal that often steals the spotlight during the later stages of a precious metals bull market: silver. While gold has captured most of the headlines, silver has quietly been building its own bullish structure. Silver isn't just a precious metal, it's also an industrial metal. Demand comes from solar panels, electric vehicles, artificial intelligence infrastructure, electronics, and advanced manufacturing. That means silver benefits from both investment demand and industrial growth. If silver is trading around $67, the next major psychological and technical objective many traders will be watching is the $80 area. Whether it reaches that level will depend on continued industrial demand, broader investor participation, and whether gold's strength remains intact. Analysts continue to see long-term support from AI, EVs, and renewable energy demand, even though silver can be more volatile than gold. If gold continues pushing toward higher highs, history suggests silver often begins outperforming later in the cycle. That's why many professional investors never look at gold in isolation. They watch both markets together. So, where does all of this leave us? The technical picture remains constructive. The macro backdrop continues to support precious metals. Central bank demand remains an important structural pillar, and many institutional analysts still believe the long-term bull market is not necessarily over. Does that guarantee gold will reach $5,000? Absolutely not. Markets never move in straight lines. There will be corrections, periods of consolidation, and moments when sentiment turns negative. But if rate cut expectations continue building, the dollar stays under pressure, real yields remain supportive, and official sector demand continues, the path toward higher prices becomes much easier to imagine. For now, $4,500 is no longer just a dream, it has become reality. The next chapter is whether that level becomes the foundation for another historic move. And if the current macro and technical trends remain intact, the question investors may soon be asking won't be, can gold hold $4,500? It will be, how long before the market starts seriously pricing in $5,000?